Well, first, let me just say that if it was not for GATA carrying my work when I first retired, we probably wouldn't be having this conversation because they did spread my initial work far and wide. So a big thank you to GATA. As far as QE to infinity goes, go back to 2007 or 2008 when they first started QE. QE never went away. The financial system has been on life support now for 11 years. And what the Fed is proposing to do now is to pull the plug on life support. It's not possible that the financial markets live through, they're talking about another 50 or 75 basis points. They're talking about raising rates to 3%. That is an impossibility. They're also, more importantly, talking about shrinking their balance sheet. That is not possible because the question then becomes who and at what price do they sell the assets to? So I'm going to tell you, in my opinion, by the end of this year, the Fed will be again in QE mode and tightening will be completely off the table. And by the end of the year, if they're, my thought process on QE starting up again is markets are going to collapse, and you're watching literally the credit markets collapse, and you're hearing stories of very tight liquidity across the board. Well, my question would be, how is there tight liquidity after all the trillions upon trillions that have been pumped into the system? And if there's tight liquidity now, what happens when the Fed starts to run their balance sheet down? Mathematically, it doesn't work.
Yeah, I heard you recently talk about, and it was surprised me actually, and I didn't realize it because sometimes we get wrapped up in the wood for the trees syndrome. You mentioned that I think that 80% of all the dollars printed have been printed in the last 10 years. That's crazy.
It's a much shorter time span than the last 10 years. It's literally within the last 2 years. And I think the number in the last 2 years is something like 40 or 50%. I'd have to go back and check, but the money supply has exploded since COVID started. And speaking of COVID, if you go back to, I think it was September 18th of 2019, that's when the repo market blew up. Repo in the US went from well under 1% overnight to 10%. And from that point forward, the Fed was having to pump in roughly $100 billion per night to keep that market under control. COVID came along, and I'm going to say conveniently, because what it did was the lockdowns really slowed the economy and it slowed the demand for credit. And it also gave the Fed and other central banks cover to be able to print currency in unlimited fashion. And they had to do that because we were literally, if you want to call the repo blow up, the Lehman moment of 2008, that's what we were facing. And the only way to alleviate that was to alleviate credit demand. And of course, COVID did that.
Yeah. And of course, I mean, really what we're seeing now is, I mean, when I start to look with my eyes open at what's going on, and sometimes I get so bogged down in the wood for the trees with the gold market. But I mean, really, we look around us. I mean, every metric that I look at tells us the banking system is completely broken.
Yeah, I agree. And from a broader standpoint, the amount of debt outstanding now is and has been for quite a few years, but now it's clear to even someone who is not into the financial markets. It's pretty clear that the debt that's outstanding is not payable. And what that means is the Fed and other central banks are going to be forced to create more and more money supply to put into the system, because as all Ponzi schemes, how they work is they always need new capital to keep it afloat. And we're at that moment now where basically the buyer, if you will, or the investor of last resort are the central banks.
A lot of people ask me, and I can't answer this question. Um, I think we see the Fed transiting or attempting to transit into a new monetary system. Obviously, it's broken what they've broken already. So I guess that would be a central bank controlled digital currency or the ability really to impose negative interest rates. Do you think that's on the cards, Bill?
Uh, I do believe they're absolutely, and it's not just the U.S. All over the world. I think you're going to see central bank digital currencies imposed. I mean, that goes along the lines of control, if you will, not your control, but their control over you. Uh, I believe that we would have had, if we had central bank digital currencies a year and a half ago, we would have had negative interest rates. You saw it in Europe. But think about it from the standpoint of the world's reserve currency. How can that possibly have a negative interest rate attached to it? Because if you really think it through, when a currency has a negative interest rate, it actually means that the currency is worthless. So how can you have the world's reserve currency with negative interest rates, meaning that that currency is a worthless currency? I mean, the thought process there is if you have a currency, and especially the world's reserve currency, if you lend that, how is it possible that you have to pay to lend it? If you have to pay to lend something, it's worthless.
I think, yeah. I mean, you just mentioned it's already in place. I mean, obviously, we're just going plain vanilla here. Obviously, real interest rates are massively negative, inverted. But thinking, I guess I'm leading into this is ultimately going to lead into some form of bail-in. They have to, in my view, it's already in place in places like Switzerland, who have a 0.075 negative interest rate. So, and obviously, my clients and people that I run into every day tell me, well, I can only pull, and no matter what's in my bank, if I go to remove my physical cash and put it in a physical vault, I'm not allowed to do so. So basically, essentially, the bail-in is already in place, and if you're restricted to in Switzerland, unless you're really well connected and you've got good lawyers, you're restricted to 200,000 maximum 300,000 euros withdrawal a year, and that even if you're extremely wealthy, that is a bail-in, is it not?
Well, yeah, they're basically ring fencing it. That's what they did back in 2008 with money markets. They stopped redemptions because they were going to break the buck. What you're saying is, what you're describing is the reason behind owning gold and silver. First off, gold and silver are the only monies, the only currencies, if you will, that cannot bankrupt in a world that mathematically is going to bankrupt. Now, in the U.S., there is within the FDIC code, this has already been written, I think this is probably 6 or 7 years back, that there will be no more bailouts. There will be bail-ins. And what that means is if you have money in a bank account, I mean, go back to, what was it, Cyprus back in 2013 or 14. They went to bed on a Friday with 100 euros, and they woke up on Monday morning and they only had 30. So that's basically what a bail-in is. And the potential for, I should say, when I say potential, and I won't even say probability, the mathematical certainty that the banking system is going to bail in their customers is the reason to, as my partner Jim coined back in 2003 or 2004, get out of the system. And the way to get out of the system is to have your money in gold and silver, because gold and silver in hand cannot bankrupt and they can't shut you off. And when I say shut you off, I mean, look at Canada. Look what they did 6 months ago during the trucker convoy. If you gave $20 to the trucker convoy, your bank account got shut off. Now, if you've got gold and silver in your hand, there's no one that can shut you off.
And you said it, in your hands, Bill. You're absolutely right, because if you've got it in a vault, it's just as easy for them to follow you in and have a look what's in your vault as they did in Cyprus for people trying to get their gold and silver out. So it's so, you're so absolutely correct. And also, do you know what? I think we did a recently interview with Robert Kiyosaki, and he just kept saying, he must have said 20, 30 times in the interview, how much physical do you have? And I think, I think that's the message I think we're trying to tell people right now. How much physical do you have?
Right. And we've talked about that for years and years. When all is said and done, you will count your net worth in ounces by weight, not by dollars, not by euros, not by yen, etc. I do want to clarify one thing. You mentioned in your hand versus in a vault. It's never wise to have all of your metal in your hand. You could have a home invasion, someone stick a gun to your wife or your kid's head or your head or whatever, you're going to give them the gold. It's always wise to have metal on hand, not in one place at your home, maybe 3 places, maybe 4 places. And it's also wise to have 2 or 3 separate vaults, more than just one country, if you want to go to the extreme. And the reason I'm saying this is because gold and silver are going to go to numbers that are unthinkable. And gold and silver will basically be the wealth that acts as the foundation for the system once it collapses and comes back up and running. So if you end up with 30, 40, 50% of the metal that you have right now, you're still going to be wealthy. But you want to make sure that you don't end up with zero metal.
Yeah, absolutely. And I'm going to ask you, you've made some really, really interesting calls on silver in the past. And really, I know that you've talked about silver as the fuse to break the financial system. Could you please explain that? Because nobody else I know has ever used that expression, but it really rang true with me, what you said.
Yeah, silver is definitely the fuse. Silver is a teeny tiny market compared to almost any commodities market, and it's certainly a minuscule market versus gold. If you look at the suppression that has taken place, and I'm going to say it really started in 1996 with Robert Rubin's strong dollar policy, basically dollar good, gold bad. The reason gold has had to be painted in a poor light is because it is a direct competitor to any fiat currency. Fiats are unbacked. Gold is real. Gold is money on its own. So it's a competitor to fiats. It's obviously the number one competitor to the reserve currency of the world, the dollar. So what they've had to do is suppress gold in order to prop up the dollar, and propping up the dollar, what that has done over the years is it has allowed and aided the U.S. Treasury to borrow. And borrowing is the only way the U.S. Treasury functions, because they run a deficit, huge deficits every year. Now, onto silver. There's no way that they could ever let silver run. If silver were to run to $100 tomorrow, you could bet that gold is going to follow right off the bat. And actually, if you look at past bull markets and bear markets in the metals, silver always outperforms to the upside, and it always outperforms to the downside. And what happens is when we're in a trend, either up or down, and I'm not talking about a week or 2 week trend, I'm talking about a 6 month, year, 2 year, 5 year trend, silver leads gold. So they cannot allow silver to come out of the box. If they do, then gold will perk its head up and start running, and that calls into question fiat currency. The other thing on silver is, because it is such a small market, I mean, total production is for the globe is less than $20 billion. And I mean, $20 billion today it's chump change. And, I never thought I'd say that. I remember when I first started in a business, the biggest deal ever done was $13 billion in 1985 or 86. And here we're talking about, trillions at a time. But silver is so small, producing less than $20 billion per year, that a cash call or a physical call is pretty much guaranteed for a big player or big players to step up and say, okay, I own these contracts, I want the metal. And the problem is there's been so many contracts sold short versus what is vaulted and available for delivery. That's what's going to blow the system up. Silver is the fuse.
Yeah, and that's so interesting because it is, and I mean, I never really thought of it in that way before, because as you say, these are the same actors, but you can read the footprints so much easier in silver. But I think bring it right to what happened. Oh, I guess really, I think it was on the 18th of April, but I think that's when we first they saw a particular game kick into play. And obviously, sometimes we get too close to these markets, and but essentially, when we saw the CME instigate a margin reduction into the silver price as it rose in above 26,225, which we all figure is probably the Rubicon line, that really where these the controller bets are probably at a risk. These are too big to fail banks, obviously holding these positions. And I know that some of them are hedged, but on the other hand, why would it's so obviously rigged when I've never in the history of trading seen a margin reduction into a silver price rise before. And it really said to me that I'm wondering, Bill, and this is what I'm going to ask you, the nickel blow up. That triggered the exit of JP Morgan and some other market maker banks to out of the base metals. But good God, surely my information is that they also now are in the position that they really would love to exit this space of being short silver. What's your thoughts?
Well, first off, nickel scared the crap out of them. Nickel blowing up and rising 250% in 2 days really, really scared the shorts. And of course, they proved that there is no longer a rule of law for us. Or I should say, there's no longer a rule of law for them. There's a rule of law for us little guys. They canceled all the trades that following Monday. So the following Monday, nickel basically doubled again, and they canceled every trade. So they basically repealed the rule of law. As far as doing and you're right, I've never seen this, and I mean, I've watched silver since the late 90s, and I've watched, they what they do is they raise margin, and then they hit silver, because what they're doing is they're raising margin on the longs, so they've got to put up money or sell. And they've done it in the last 20 years. They've probably done it, 20, 25 times. You see the waterfalls. This time around, and here's why I think they actually did this. I just mentioned to you that in all markets, we're seeing that liquidity is extremely tight. And it's my theory or my thought process that what's going on in other markets is also going on in gold and silver. The liquidity's not there. So what did they do? They rather than raise margin rates, they lowered them, and it allowed the cabal, whatever you want to call it, it allowed them room to lever up further on the capital that they had outstanding. It allowed them to sell more paper contracts, and that's what they did. It basically caused a it caused the waterfall, and we saw basically a 2-week collapse. So my thought is that lowering the margin requirements actually allowed the short side to get more short. So where we were 2 or 3 weeks ago before this waterfall, I think it's more of a dire situation between paper versus physical than it probably has ever been.
Yeah, that's exactly it. You've nailed it. I mean, it is a. I mean, we look at, the more we look at it, the more we see this divergence between paper and physical. And I mean, basically, this was clearly, and I take the same view. This is clearly a bailout of this massive. I mean, only to look at the OCC report, and yes, okay, so we look at the size of it and we realize that you probably have to dilute maybe 20% of that report for platinum, palladium, that kind of stuff. But I mean, primarily silver, and so yes, some of it is hedged, but my God, that was a massive. Those positions are so vulnerable at this point. And I guess I asked some of my liquidity providers, look, do you honestly think, if following this Russian sanction blowback, where really all commodities need to be repriced in some way or form or another, I mean, do you really think if you just landed from Mars yesterday and you looked at this grossly undervalued silver market and you looked at all the commodities, would you instigate a multi-billion-dollar short position against silver? They think not.
Well, first off, if you landed from Mars yesterday, you'd turn around immediately and go back. As far as this is now all about liquidity. We're running up against the wall in all the markets, and for the shorts to get more short, double down, triple down, whatever, the likelihood of a cash call, and when I say cash call, I'm talking about a call for delivery, the likelihood of a call for delivery across the board has jumped magnitudes. Because I think, first off, the powers that be have told you there's going to be a reset. We happen to believe there's going to be 2 resets. One by the elites, which will fail, and then the final reset will be done by Mother Nature. And of course, that's basically cash trading, no more futures. When you're settling trade, it's something real for something real. And really, that's what Russia is talking about now. They either want their own currency or they want gold. And I'm sure they want their own currency because they know that they're only 14% debt to GDP. The US is 110% to GDP. Japan is 300% to GDP. They realize the West is bankrupting. They no longer want to give something real for something fake. They want real and true settlement, because when you accept dollars, it's not real settlement. You're accepting further promises. But when you accept gold, when you accept a currency that is backed by something real, that is real settlement. The trade is consummated and settled, final. Rather than the dollars go on and on and on and on with promises of more interest.
Bill, I know, obviously I know that this is, one could look at this question many, many times in different ways. But right now, assuming that the average person is looking at both gold and silver and they're weighted, say if they were weighted evenly, would you suggest silver might be a better political move than gold, or what would you suggest people look at?
I'm not sure what you mean by political move.
Oh, in the sense that gold maybe could be confiscated, but silver could never be confiscated.
Okay. I would not say silver could never be confiscated, because silver has so many different uses. Governments could come out and say for national security interest, because we've got to make bombs and missiles and blah 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 that use silver. We're calling in silver. There's really not enough at current prices. There's not enough silver outstanding to make a difference. And you're right. There's what, $7-8 trillion of gold at today's prices that have been mined since the beginning of time. So yeah, that's still small in relation to the whole system, but it is something. As far as a weighting is concerned, the current ratio is what, 84 to 1, something like that. And it comes out of the ground, call it round numbers, 10 to 1. So God's ratio is 10 to 1. Man's ratio is 84 to 1. One of them has to be wrong. One of them has to be right. And I can tell you which is which. When the shenanigans of derivatives, futures products, paper products, etc., when those are all gone and we're back to a if you want to call it a cash and carry economy, financial system, etc., I would guess that the silver to gold ratio will probably fall back to the 20 or 30 level, maybe lower. A lot of people don't realize that for literally hundreds upon hundreds of years, it was 16 to 1, even though it came out of the ground at 10 to 1. And the reason being, go back 300 years, 400, 500, 1,000 years, in order to transport money, you had to do it on a mule or a horse or what have you, which meant you had to carry 10 times more weight in silver than in gold to get the same capital to its destination. So because of the weight, silver was discounted to 16 to 1. That's the reason for the 16 to 1 difference from the 10 to 1. As far as the weighting, 50-50 or what have you, I advise people, and obviously they do what they want to do, but my advice is be at least 70-30 to silver, with an eye in the future of becoming 70-30 gold to silver. In other words, when the ratio drops from the current 83-84 down to between 50 and 60, you might want to take a quarter of your silver and turn it into gold. If it gets down to 40, you do another quarter, so that you get to 70-30 gold to silver, but you're going to end up with more gold ounces than if you did it today, because you're using the strength in silver to purchase more ounces of gold than you would with that capital today.
That is so interesting, Bill, because I never thought of it that way, nor did I realize that 16 to 1 ratio was, it makes sense. There was me thinking that it was the ratio of gold to silver coming out of the ground, but no, that makes 1,000%, that makes sense. I think also, and I don't want to call it, I know you're on satellite here and you've been very generous with your time. I just going to ask you, Bill, now looking at the EFPs right now in silver, and I'm looking at silver in particular because silver is really, really interesting. As you say, it's the fuse. So maybe let's focus on that. But the last week, when silver was being driven down, between 22, 21, I noticed that the usual contango where you got, to keep the game going, usually in the futures market, you have 17, 20%, 20 cent, maybe premium in the futures position versus spot. It reversed to a 10-cent technical backwardation in silver, so that spot was essentially 10 cents higher priced than to be honest, I don't recall that happening since March 2020, when we saw the big noticeable gold EFP blow up, where we saw liquidity providers in London suddenly, basically suddenly being turned on because of a physical shortage to deliver their over-the-counter contracts, and they're hedged on the spot market in the US, and suddenly their spread runs $80 to $100 for them to race to bail themselves out from not being able to deliver physical. So interesting to get your thoughts on silver.
Yeah, you basically described backwardation, and it's probably worth explaining that. Uh, what that means is the spot price today is higher than next month's future, or 2 months out, 3 months out. The reason being, in the most severe form, is people are saying, I want my silver, I want my gold, and I want it now. I want it delivered now because I don't trust that I'm going to be able to get it delivered in a month, in 2 months, in 3 months. That's what backwardation is all about. It's a lack of trust, and it shows extreme tightness in the market. As far as the EFPs go, uh, the one who tracks that more than anyone else, I believe, is Harvey Organ. Uh, Over a 12-month period of time, I think for 2021, what was the number? Uh, that I think it was 8,000 tons of gold were EFP'd to London in a year's time. Well, that's ridiculous because total global production without China and Russia is under 3,000 tons. So 8,000 tons, I mean, that's 2+ years of global production. And there's no way to track it. Once it gets to London, there's no way to track whether that metal was really delivered. And I'm going to say, from my point of view, the numbers, they don't add up, they don't make sense, and it's impossible that there was an extra 8,000 tons of gold laying around to deliver on contracts that couldn't be delivered on COMEX.
Yeah, exactly. And obviously the same goes for silver, but it exponentially impacts silver sort of more, doesn't it? But it's interesting that that happened. So again, I'm just kind of watching this EFP situation because, as you say, backwardations, EFPs, that is where we saw March 2020. We saw the blow up where literally, and although it was for different reasons, although it was because of COVID shutting down the European refiners and they weren't able to produce, therefore there was no physical, therefore you turned on the liquidity providers, over-the-counter liquidity providers in London, for example, and said, okay, well, give it to me. But again, that hedging mechanism from paper to paper, it blew up. And I think we're back there. And I think because whether it would be because of the blowback for sanctions in Russia, maybe whatever. But I mean, the thing is, suddenly, when we calculate what is a commodity price, you look at the historical, suddenly you've reset. Hang on a minute. This is not, these historical anchors have changed. We've suddenly created a situation where commodities are going to accelerate the price of commodities versus the dollar, for example. So this is really unprecedented time. And I think anyone short any of the metals, so especially silver, is going to get burnt so badly.
Yeah, as I mentioned, they've told you there's going to be a reset, and the reason, or the reason in the paper markets for the problems is that, as I mentioned, liquidity across the board has gotten tighter and tighter, and as liquidity gets tight, that means that the short side is the one that's affected, not so much the long side. The long side, who's actually looking to buy, pay for it, make settlement, take delivery, liquidity is not going to bother that side. It's the short side that liquidity is going to affect, and it is affecting the short side where we are right now. And we are back to, like you said, we are back to March of 2020. But remember, this is after tens of trillions in capital have been pumped into the system, but now all of a sudden the liquidity is tight again. They're going to have to do QE exponential to try to keep this thing together.
I hear you, Bill. This is really informative. I thank you so much for sparing your time. I know we've had some technical issues today and you're on satellite and it's a cloudy day and all the rest of it, but thank you so much for your time. Is there any final parting message that you have for all the people? Obviously, people can find you. They know where to find you. We will put up a link to where you are. Any final message for everyone, Bill?
Yeah, I would just say from a personal standpoint, for your listeners, viewers, the best thing that they can do is have a mindset of self-sufficiency. Get as much of your life, if you will, out of the system. Don't rely on the system to provide for you, because it's not going to. And when I talk about to provide for you, don't think that when the financial markets collapse, that you're going to be able to just keep going to the grocery store and getting food, because everything relies on credit. And when credit breaks, everything, and I'm talking about everything. I'm talking about electricity. I'm talking about water. I'm talking about food supplies, transportation, you name it. Everything is going to be damaged. Will it completely collapse? I don't know. Will it completely go away? I don't know, but it's going to be severely hampered, and the odds of a complete collapse are actually pretty good. So my advice is try to become as self-sufficient as you possibly can and get your capital out of the system where it can't be shut down, taken away, what have you.